Hey, and welcome to Financial Reactions. Have you ever been interested in covered calls? What are they? How do they work? Well, let's take a quick look at an overview of how covered calls work. A covered call is one of the simplest, most popular option strategies. It is designed to generate income from stock you already own. Here's the basic idea. If you own at least 100 shares of a stock, you can sell a call option against those shares if they're available. When you do that, you collect a premium up front. You get paid for selling one call option. That's your income. In exchange, you agree to sell your shares at a specific price called the strike price. If the stock rises above that level by expiration, you have to sell. So you're trading some potential upside for guaranteed income today. Covered calls work best when you think the stock will stay flat or rise just a little. You keep the premium, and ideally, you keep the shares also. In this series, we'll break down how the strategy works, how to choose a strike price and expiration, how to manage the trade, and how to build consistent income using covered calls. Let's walk through the strategy actually functions. When you sell a call option, you're giving someone else the right, but not the obligation, to buy your shares at a specific price before a specific date. In return, you collect a premium up front. That premium is yours to keep no matter what happens. If the stock stays below the strike price, nothing happens. If the option expires worthless, you keep the premium and you still own your stock. If the stock rises above the stock price, the buyer may choose to exercise the option, and your shares can be sold at the strike price. Either way, the premium you collect is locked in as income. Requirements when it makes sense. To use covered calls, you need to own at least 100 shares of the stock for every contract you want to sell. This strategy works best on stable, high-quality companies, the kinds you're comfortable holding long-term. Covered calls shine in sideways or slightly bullish markets where the stock isn't expected to explode upward. If the stock surges, you may have to sell your shares at the strike price, which means missing out on some upside. So the key is choosing a stock you believe in, using the cover call to generate studying. You will hold them. How to place the trade. Placing a covered calls is straightforward once you know what to look for. Start by choosing an expiration date. Many income-focused traders prefer around 30 days. However, some stocks you can actually do weekly. So if you're thinking maybe something will happen in 3 weeks and don't want to risk writing a month out, you can do a 3-week, a 2-week, or a 1 week. Next, pick a strike price that is above the current stock price. So if your stock's at $9.80, you'll want to pick something in the $10 or $10.50. Generally, on the lower price stocks, they go up in 50-cent increments, and as the stock prices increase, it'll be more like $1 to $2, maybe $2.50 for each strike price. But you'll have to see that through your brokerage and how they run it. On your brokerage platform, select Sell to Open and choose the call option you want to sell. Before you confirm the trade, check the option chain, the bid-ask spread, and the stock's recent price action. A few quick checks can help you avoid bad fills and low-quality premiums. Income potential and returns calculation. Covered calls can generate meaningful income, but it's important to understand how the numbers work. Your premium yield is simply the premium divided by the stock price. For example, A $1.50 premium on a $50 stock is a 3% return for that option cycle. If you repeat that monthly, the annualized returns looks impressive, but remember, real worlds vary. Covered calls also lower your cost basis. Every premium you collect reduces the effective price you paid for that stock. This helps cushion downside moves but doesn't eliminate risk. The goal is steadily reliable, realistic income, not chasing hype. Once your covered call is active, your job is to manage the position based on what the stock does. If the stock rises toward your stock price, you may choose to roll the option, moving it to a later date at a higher strike price. If the stock stays flat, that's ideal. You simply let the option expire and sell another one. If the stock drops, you can hold the shares, exit the position, or roll the option down to collect more premium. There is no single right answer. You'll kind of have to learn this as you go. The key is to have a plan and adjust as the market moves. Covered calls are powerful, but they come with trade-offs. You need to understand if the stock rises above your strike price, you may be assigned, meaning your shares are sold at the strike price. That locks in your profit, but it also means you miss out on any additional upside. This only happens if the buyer of your contract actually exercises the contract. If the stock drops, you keep the premium, but your shares may lose value. Covered calls cap your upside in exchange for income today. But that's not a bad trade as long as you know the risk and choose stocks you're comfortable with owning long term. Building a covered call income plan. Turn your covered calls into consistent income strategies. Start by defining your goals. Decide how much monthly income you want and how much risk you're willing to take. Sell calls regularly, weekly or monthly, and diversify across multiple stocks if possible. Track your trade so you can see what's working and what needs adjusting. Reinvest your profits, stay disciplined, and scale up over time. Used correctly, covered calls can become a reliable tool for long-time building. That is what a covered call is in a nutshell. I'm working on a new video. I'm going to actually show you actual trades on an actual platform. I personally use Thinkorswim, and I have my paper count set up so I can do multiple transactions to show you guys how it works. Also, if you're into covered calls or you think you want to be, let me know and give me a stock, and I will actually do a paper trade on that particular stock. I'll buy 100 shares, and then I'll do a covered call to show you how it would work on a stock you actually pick. But you have to do me a favor and hit that like button, and in the comments, tell me what stock you want to see. I should have this video out in the next couple of days. Today is April 5th, so you should be looking for that shortly. Thank you guys so much, and remember, take care of your finances, take care of your health, and we'll see you in the next video.